Solved problems. Process accounts. How to prepare process accounts, normal loss, abnormal loss, and abnormal gain. Problem. Product Simba is made by processing materials in 3 sequential processes 1, 2, and 3. The details of the process costs for the financial period 2 were as follows. Process 1, Process 2, Process 3. Direct material introduced 5000 kg, Process 1 40,000. Direct material added, Process 1 12,000, Process 2 25,280, Process 3 46,400. Direct labor 10,000, Process 1, Process 2 12,000, Process 3 20,000. Direct expenses, Process 1 8,000, 12,400 for Process 2 and 8160 for Process 3. Budgeted departmental overheads for period 2 were 168,000 and absorbed into the cost of each process on a percentage of direct labor cost. Output and normal loss data are as follows. Process 1, Process 2 and Process 3. Actual output, Process 1 4400 kg, Process 2 4200 kg, Process 3 3500 kg of product Simba. Normal loss, Process 1 10%, Process 2 5%, Process 3 10%. Normal loss is partially toxic material and is sold at K2, K6 and K10 in processes 1, 2 and 3 respectively. There was no finished inventory at the beginning of the period and no work in process at either the beginning or end of the period. Required: A. Prepare process 1, 2 and 3 accounts. B. Prepare abnormal losses and a normal gain account showing balance to be transferred to the statement of comprehensive income account. C. Explain the distinction between a byproduct and a joint product. Solution. Process 1 account. On the debit side, direct material quantity 5000, rate 8, amount 40,000. Direct material added 12,000. Direct labor 10,000. Direct expenses 8,000. Budgeted overhead 168,000 by 42 into 10 in proportion to direct labor cost 40,000. Total expenses 110,000. Output on the credit side 4,400 units and the normal loss is 10% of 5,500 units. Abnormal loss 100 units. And the rate is worked out as under. Total expenditure is 110,000 less normal loss. Sales 500 into 2 1000. Net expenditure 109,000. Total output is 4,400. Abnormal loss 100. Rate for 4,500 109,000 by 4,500 is equal to per kg 24.22 is the rate, and it is the split into output 4,400 into 24.22 106.578 is the output amount. Abnormal loss amount is 100 into 24 into 2 is equal to 2422. Total expenses 110,000 and the total output cost plus normal loss plus abnormal loss is 110,000. Process 2 account. On the debit side, from process 1 4,400 units at 2422 106,578. Direct material added 25,280. Direct labor 12,000. Direct expenses 12,400. Budgeted overhead 168,000 by 42 into 12 in proportion to labor. Direct labor 48,000. Output 4,200. Normal loss 5% of 4,400 is 220. So there is a total output of 4,420 units, whereas the input is 4,400. That means there is an abnormal gain of 20 units. Now let us work out the rate for abnormal gain and output. Total expenditure prior to abnormal gain is 204,258 less normal loss sales 220 into 6 1320. Net expenditure is 202,938. Total output 4200. Abnormal gain less 20. Net output is 4180. Rate is equal to 202,938 by 4180 per kg. It is 48.55. So output cost is 4200 units into 48.55 is equal to 203909. Abnormal gain value is 20 into 48.55 971. Process 3 account on the debit side from process 2 4200 units at 48.55 203909. Direct material added 46400. Direct labor 20,000. Direct expenses 8160. Budgeted overhead 168,000 by 42 into 20 in proportion to direct labor, it is 80,000. Total expenses 358,969. Total input 4,200 units. Output on the credit side, output Simba 3,500 units. Normal loss 4,200 to 10%, 420. Its sale value is 420 into 10, 4,200. So there is an abnormal loss of 280 units. So let us work out the cost rate per output Simba and abnormal loss as below. Total expenditure 358,469 less normal loss sales 420 into 10 4,200. Net expenditure 354,269. Total output 3,500. Abnormal loss 280. The rate per unit is 354,269 by 3780 93.72. Output 3,500 into 93.72 is equal to 328.027. Abnormal loss 280 into 93.72 is equal to 26,242. Abnormal loss and abnormal gain accounts. Abnormal loss account on the debit side, process 1 100 kg 2422 is the rate, amount 2,422. Process 3 280 kg 93.72 is the rate and the amount is 26,242. Total abnormal loss 380 units and the value is 28,664. On the credit side, abnormal loss transferred to income statement 28,664. Abnormal gain account on the credit side, process 2 20 units at the rate 45.52, amount 971. On the debit side, abnormal gain transferred to income statement 971 rupees. Byproduct. Any product that is the incidental result of the process of production is called a byproduct. Derived from the pre-existing material used to manufacture the main products, a byproduct has a lower net realizable value as compared to the sale value of main product, since its occurrence is not a priority but a consequence of the production process. The byproduct may be processed further to increase its saleable value or be sold off at scrap value depending on its usage. A joint product is the products which are simultaneously produced using the same input in a common process, and each product carries considerably high sale value. Also, none of the joint products can be recognized as the major product. The raw material is processed in order to produce more than two products. A separation point called split-off point segregates the identity of the joint products from where they are either processed further or sold as they are. Difference between joint products and byproducts. The major point of difference between joint product and byproduct are given below. Meaning, a joint product is one which is manufactured ancillary to the production of the main production. Hence, its purpose is intentional. However, a byproduct is purely an unintentional consequence of the production of the main product. To input, joint products are manufactured using raw materials from the first step. Byproducts arise out of the scrap of a given production process, since there is no intention to create a byproduct. 3. Further processing. After the split-off point, the product Joint products go through their own further processing to be turned into individual final products. Byproducts are generally end resultants that are not processed further and simply sold off to its concerned industry. 4. Economic value. All the joint products are priced equally when it comes to their economic value. They also share production costs up to the split-off point, which is called the joint cost, after which individual further processing costs are added to the products. Byproducts are sold at a lower net realizable value or at scrap value. Production. A joint product is manufactured consciously and simultaneously along with the main product, whereas the byproduct is simply an incidental result of the manufacturing of the main product. Usage. The joint products have independent uses of their own in the market or may be used as ancillary counterparts, but the byproducts are not contributory to the main product in any manner whatsoever. Recap. Thanks for watching. Please subscribe to our YouTube channel Accounts Lobby for various solved problems and lectures on accountancy.